Good day, ProLife. I'm here to talk to you about pulling through the outbreak, investing during challenging times. This morning, we will be talking about opportunities in the financial markets. And as a disclosure, the views expressed in this presentation are solely attributable to me and does not necessarily represent the views of ProLife UK. No part of this presentation may be reproduced without prior permission. This morning, I'll run you through the economic overview, snapshot of top global countries, and we will compare also how we are performing with respect to key financial and economic indicators. Next, we will proceed with COVID-19 cases update, where I will run you through the number of cases and deaths, and also some safety ranking done by an independent organization with respect to global ranking and ranking in the Asia Pacific region. After that, we will take a look at the Philippine economic and financial indicators. Then we will look to market outlook, opportunities for bonds and stocks. After that, as we know, with any investments, there are key risks that are involved, and we will take you through external and internal risks that we are currently faced with. Next, I will take you through the investment strategy. I will take you through a short-term and long-term strategies. Again, I would like to mention that these are my views and these are consistent with my risk profile, my risk objectives, and risk philosophy and understanding of financial markets. Each one of us will have to make sure that we are aligned with respect to what we know as KYC, with respect to our own risk profiles and our own objectives. Now let's take a quick look at the economic overview. As I mentioned, we will take a look at the top 7 countries and by GDP. These are the US, China, Japan, Germany, UK, France, and India. And at the bottom, you will have the Philippines so that we can compare in terms of size and other key economic and financial performance. Next is GDP. As we said, US is top in terms of GDP with 21 trillion. The numbers expressed here are in billion dollars. So US is 21 trillion. You'll notice that the Philippines is only 356, which means the size of our economy is just 1.5% that of the US. Next column, we will be seeing the growth of GDP in the 4th quarter of last year on an annualized basis. You will see here that the US grew by 2.3%. That's the highest already in developed markets. Japan even contracting in the 4th quarter, Germany, UK, and France, marginal growth last year. And we will see that emerging markets represented here by China, India, and the Philippines have been outpacing other more developed nations in terms of economic growth. That's critical because ultimately what determines the returns on stocks will be long-term GDP growth of the respective countries. We will skip interest rates for the moment, and we will look at the government budget, the 4th column. So we will see here that this is basically fiscal deficit per surplus of the countries. So if you have a negative, which means the country is spending more than its collections. The collections of the countries will be corporate income taxes, individual income taxes, customs and duties, and other fees charged by different government instrumentalities. So we will see here again, US at minus 4.6, which means minus 4.6% in relation to their budgets. Because if we look at absolute numbers, then this might be disproportionate. So we are looking at budget deficits or excesses in relation to its GDP. So we'll see here, US spending 4.6% more than its collection in terms of its percent to GDP. What's critical here is that your deficit should be smaller than the GDP growth. So notice, again, US, Japan, UK, and France, their fiscal deficits in percentage of GDP is bigger than the growth of GDP, which means over time, their debt ratios will be increasing. Countries who have lower fiscal deficits or who have surpluses will be showing lower debt to GDP over time. So you see here again, emerging markets represented by China, India, and the Philippines are outperforming in this particular measure the more developed countries, except for Germany, which is the only country reflecting a fiscal surplus. Next is debt to GDP. Again, you will see here that developed nations would have much higher debt to GDP compared to emerging markets. Again, with the exception of Germany. US is over 106%. This is color coded, so when you see it's red, really a bad sign. So Japan has the worst ratio here, 238% of GDP. So that's why you will notice that the bigger normally your GDP over time, you will have smaller growth in your GDP or sometimes even contraction. In fact, the Japanese economy over the last 20 years has been hardly growing, principally because they have high debt to GDP. US is trending in that direction. Before the last global financial crisis in 2007 to 2009, debt to GDP of the US was only 65%. And it has increased continuously, ending last year at 106.9% because of the stimulus packages, bailout packages, and the fact that its economy has not really been able to restart. Again, here, Philippines ranks the best among the top 7 countries at only 41.9% of GDP. India is also doing well at 69%, and China. Next, we will go to interest rates. We are showing interest rates because this will present, number one, opportunities for us to invest in markets. Is it better to invest in the developed markets or in emerging markets? So we will see here, interest rates represented by short-term placements will be very low in advanced economies. US at 0.25%, Japan is even negative. That's correct, it's negative, meaning you still have to pay the government for them to take your money in the short term. Germany and France are zero, no yields for short-term placements, and UK at 0.1% short-term placement. Again, the opportunities for investments in bonds are not in the developed markets, but are in the emerging markets, where you see China at 4%, India at 4.4%, and the Philippines at 3.25%. Again, you will notice that times have changed. In the past, what you say is that high risk, high return. The developed nations have higher risk measured by debt to GDP, but the returns are very low in that side of the world. So you see, again, investment opportunities on the bond market will be in the emerging markets. I guess that's why we are positioned in those funds. We are not really aggressively investing in developed nations' fixed income plans. And then last column will be population, just to show you that our population is a third of the US. We have 100 million and they have 300 million. Because later on, when we take a look at the COVID cases, then we'll see that there is a disproportionate exposure and to COVID-19 with respect to these advanced economies. Japan is 26%, about 20% bigger than the Philippines. Again, you'll notice here, Germany, UK, and France even have smaller population compared to the Philippines. Again, when we look at the coronavirus cases, they will have very high numbers in terms of cases and deaths. Obviously, we know that China and India both have over 1 billion in population. And so we said that the current situation where we have this pandemic, it has caused most economies to grind to a near halt. And early indication is that China is reflecting already a contraction in GDP. As we know, this all started in China, so late last year. And so for most of first quarter, the economy was impacted negatively. And we will see here that the economy contracted by 6.8. This was coming from a fourth quarter growth of 6%. This is the first drop of the China economy in 28 years. Again, this shows you the magnitude of how coronavirus is impacting economies. This is an early warning signal. More GDP numbers from different countries come in for Q1. Obviously, Q1 will be more impacted in most economies because this is the second quarter where we had lockdowns in most countries, which are remaining to this day. US has also released their first quarter GDP, and it contracted by 4.8% compared to a growth of 2.1% in the last quarter of last year. So the average last year was 2.2, but fourth quarter was only 2.1 last year. So again, we're seeing a swing from plus 2% to minus 4.8. That's almost 7% swing in the GDP of the US. Again, it was noted that consumer expenditures declined by 7.6% in the quarter. and it already represents 2/3 of the economy of the US. We expect bigger drops in Q2, as we've seen that the lockdowns have taken effect mostly in the latter part of February or early March. Exports also dropped and imports also dropped by 15%. Here are some data on the coronavirus in terms of cases and in terms of deaths. Globally, there are now 3.5 million cases, US accounting for roughly a third of that at 1.16 million. Philippines numbers look small, but again, some of you might say, well, because we are not doing a lot of testing compared to other nations. That's correct. But you will also see that in terms of number, France, Germany have much smaller populations, but their numbers in coronavirus are way disproportionate compared to ours. Well, so I guess that should be a better measure than cases because of testing differences. Some are doing a lot more testing than others. Deaths in the Philippines, again, is a lot smaller compared to the US. It's just less than 1%, again, despite the fact that their size is only 3 times bigger than the Philippines. But in terms of deaths, there are 100 times more deaths in the US compared to the Philippines. I guess the fact that Philippines undertook a lockdown early on in coronavirus situation, it is benefiting us in that sense. So let's not jump too soon about those numbers where Philippines is really not impacted as heavily as other nations, because this slide will show you the safety ranking. On the left, we'll have the global rankings. Israel ranking first, Germany second, South Korea number 3. And on the right side, you will have the rankings in Asia Pacific. Unfortunately, we ranked last, even the likes of Myanmar, Cambodia, Laos, Bangladesh ahead of us. The rankings reflect lowest likelihood of infection, lowest chance of mortality. In fact, the WHO even commented that the doctors are more exposed really in the country, as we've seen a number of deaths from our medical professionals, our frontliners. Highest likelihood of recovery, but these studies are being done almost every 2 weeks. So I guess in the recent weeks, we've seen a good number of recoveries in the Philippines. So hopefully our standing will also improve over time. So this is also based on efficiency of quarantine and government management, monitoring and detection, and emergency treatment readiness. Let's now move into economic forecast for Q2. First in the US. Goldman Sachs, Morgan Stanley, Bank of America, JP Morgan, UBS, all forecast very steep declines of the US economy in Q2. And again, I'm not an economist, so I rely on the top economists of these financial institutions to give us a preview of what we may expect for Q2 in the US economy. And Bank of America even saying that up to 20 million jobs will be lost. In fact, this data has been outdated already. They came up with this study late March, but as of last week, more than 24 million jobs already have been lost in the last 5 weeks in the US. So again, they're saying that they expect the US recession to be the deepest since the 1940s. Not one of us has been alive during the early 1940s, and we don't know much what happened then. So we are right now in uncharted territory. So all the experiences we've gained during our lifetime in dealing with financial markets, we are expecting that we might be faced with new challenges as we move forward. UBS even saying that the US will be in very deep recession by July. Usually recessions are defined by 2 successive quarters of economic contraction. That's why people are saying it will start in July, because they expect contraction in Q1 and then another contraction in the economy in Q2. Here now our forecast for the global economy. Deutsche saying that we are going to be in the deepest recession ever since the 1940s. Again, not just for the US, but it's the entire global economy. Standard Chartered says that we will be experiencing the worst peacetime disruption to the global economy since dating back to the 1929 up to 1931. IMF says that global economy will be contracting this year by 3%. This will be worse than the last global financial crisis, which we saw in 2007 up to 2009. Here's the more detailed forecast coming from the IMF. as they said, the global output will be expected to decline by 3%. The advanced economies will be declining by a bigger amount at 6.1%. And you will see that emerging markets will be declining marginally this year at only -1%. So that's why, again, our funds are positioned in the emerging markets because the economic outlook for the emerging markets is much better compared to economic outlook of advanced economies. And you will see here country by country. In our region, developing Asia, we expect even a positive growth for this year, despite the impact of coronavirus. And again, if we look further ahead by next year, in 2021, global output will rebound by 5.8%, again lagging the recovery efforts in 2021 or next year will be the advanced economies because we will see much faster growth in emerging markets. So at a pace practically double that of 2019. So that's going to be happening. So again, these forecasts are based on certain premises that hopefully they will contain the virus, either find a vaccine, or at least they would have moderated the growth of the cases by Q2 or second half of next year. Again, that's why our funds are positioned on emerging markets because the growth this year and next year will be faster in this segment of the global economy. Moving closer to home, ADB, their forecast for Asia, the whole of Asia, developing Asia, they are seeing growth this year at 2.2%. Again, a recovery of 2021. As we know, investments are forward-looking. What the investments are making right now are in anticipation of what's going to happen in the years to come. So not necessarily what is happening right now, because markets are forward-looking. Here's another slide where economies are ranked in 4 measures of financial strength: public debt, foreign debt, cost of borrowing, and reserve cover. This is for emerging markets. And you will see again, in terms of emerging markets, Philippines ranked very high, number 6. Those ahead of us are Botswana, Taiwan, South Korea, Peru, Russia. We're even ahead of China here, Thailand, India is even here, number 18. These are key financial measures of financial strength. So globally, we're ranked very high. Lowest will be Venezuela, all reds in those 4 measures of financial strength. Again, this shows us that on our local market, there are very good opportunities as we expect to weather the financial storm that we are experiencing this year better than most countries. And as a whole, emerging markets are also expected to weather these storms better than developed markets. Now, closer to home, we have before you the last 30 years of economic growth in the Philippines. You will notice that prior to 2004, when EVAT was put in place, we hardly experienced growth above 5%. So there's only 2 periods of time, in 1996 and 1997, where our economy grew by over 5%. After EVAT was put in place in 2004, hardly there were years when our economy grew by less than 5%. You will see it's very important that you control your fiscal deficit, that you control your debt to GDP ratios. Those are the key things I measured in my earlier slides when we compared the developed markets compared to emerging markets. So you'll see here that, in fact, last year, our economy grew by 5.9%. That was the lowest since we had experienced 3.7% growth in 2011. We are showing a slight decline in the last 4 years. We were experiencing growth in the last 3 quarters of last year. In the first quarter of last year, our economy grew by only 5.6%. It bottomed out at 5.5%, but it started to show growth in third quarter and fourth quarter. At fourth quarter, growing at 6.4%, therefore averaging only at 5.9% last year. If we look at the GDP growth last year, bulk is attributable to consumption expenditures, household expenditures. So basically, our economy on that side grew by 5.6% compared to 5.8% the year before. And despite the fact that government spent a lot for its build programs after the passage of the train law, its expenditures grew by 18%, 18.7%. Our economy still slumped because government expenditures only accounted for less than 20% of our GDP. It is really the personal consumption that's driving our economy forward. In terms of capital formation, these are the investments made both locally and by foreign investors. There was hardly any growth last year, growing only by 0.4%, and the previous year even contracting by 0.6%. So that is our performance in terms of expenditure side. On the industrial origin side, for last year, 7.9% was represented by the growth in services sector. Insurance, banking sectors are part of the services sector. Again, that's more than 2/3 of our economy. So it's very critical that these are the industries that drive our economy forward. Industry, the manufacturing sector only grew by 5.4. Agriculture, this is the smallest segment of our economy. Despite the fact that it grew by only 1.5, it hardly impacted our growth last year of 5.9% in totality. As I mentioned before EWAT was put in place, our debt ratios have been on the rise. EWAT was put in place in 2004. A lot of people were angry with Senator Recto and GMA, but in fact, they were responsible for bringing fiscal order in our country. We saw our debt ratios and our fiscal deficit at very high levels prior to 2004. These are the positions that we now see the US and other advanced economies having deficits of 4% and economies only growing at less than 4%. So when EWAT was put in place, we saw our debt ratios coming down. We saw our economic activity improving because more and more funds are being used by government to fund infrastructure projects and to help the economy grow. Compared to when you have high debt ratios, more and more funds are being used for debt servicing. So this is what the advanced economies are faced with right now. More and more of their funds currently and into the future will be used to pay debts and service debts. Therefore, the economies moving forward will be slowing down. In fact, even at this point in time, their economies are hardly growing. So what more as they move forward, unless they will address their fiscal deficits by either raising taxes or reducing expenses. So we are here right now, less than 42% debt to GDP. When you control your debt to GDP, then you will see your economy moving forward at a much faster rate. As I mentioned earlier, prior to 2004, we hardly saw 5% growth in our economy, but after EWAT was put in place, we hardly saw below 5% growth in our economy. So that's how important managing our fiscal deficit is. And we will note that the US, despite having 100%, over 100% debt to GDP, for this year, they're coming out with bailout packages of 10% of their GDP, and their central bank, represented by the Federal Reserve Board, is even allocating another over 25% of GDP for bailout packages. So we will expect that the debt ratio of the US will even be way higher by the end of this year. But that's their way of addressing the current fiscal crisis. Because if they don't do that, then a lot of the jobs will be mostly gone into the future, and the economy will even be contracting a lot more this year. So they are really addressing the situation through very aggressive stimulus responses. Now let's take a look at 10-year government bonds. This is what the government will pay you when you invest in their bonds. In the past, the Philippines had to borrow at a higher rate because we had an increasing debt to GDP ratio. We had a very high fiscal deficits. And so it was very risky to invest in Philippine bonds, especially if you're coming from the outside. But as we controlled our debt to GDP, interest rates that Philippines now pay have dropped substantially. Before, it was over 16% for 10-year bonds. Okay, now it's only 3.5%. And again, this is what I was saying earlier, that markets anticipate the investments we make right now are for the future and not for the present time. Because if you recall, the Philippines achieved the investment grade status on our sovereign debt in 2013. In 2013, March of 2013. And this is the time that a lot of people were saying, you know, lower risk for the country because we're now no longer a junk status. We are now BBB, the lowest ranking investment grade status for sovereign bonds. And so, you know, there should be lower interest rates for the Philippines. Markets are forward looking. Even before we became investment grade, investors were already anticipating that because they were seeing the improvements in our fiscal position, in the revenue collections of government. And that's why, when we achieve investment grade, interest rates started to move up. See, it's the reverse. When people were saying that was a time to invest in bonds, I was saying at the time, no, get out of bonds at the time because interest rates will start to move up. That is how markets perform. Markets are forward-looking. It anticipates what's going to happen, and it is not reflective of what is happening right now. We are positioning for the future. That's why people were saying here, this time to invest in bonds, in stocks, and it was not the time to invest in stocks and bonds. The time to invest in bonds and stocks are when prices are low. Remember, the key thing to making money investments, buy low, sell high. You also want to invest when bond rates are high, and maybe try to be cautious when bond rates are very low. Then again, if we compare our 10-year government bonds to 10-year government bonds issued by other governments, US only pays 0.58% per year for 10 years, okay? That's not even 1%, just a bit over 0.5% per year. UK at 0.22, Japan, Germany, France, and Switzerland, you would even have to pay them if they hold your money for 10 years in the ranges of 0.03 for Japan all the way up to 0.58% for Germany. It's like having a warehousing cost. You hold my money, and for warehousing my money, I pay you. It's the reverse that has been happening. And something is new is that in the past you say high risk, high return, but now we're seeing that these advanced economies have very high risk in terms of debt to GDP ratio, of course, except for Germany, and yet the returns are very low, and in some cases even negative, especially for Japan, whose debt ratio is over 200%. Again, Indonesia, China, India, and the Philippines have way positive numbers. That's why, again, even on our investment side, whether it's bonds or stocks or balance funds, we are focusing on Asia because on bonds, there are returns to be made on fixed income, as well as the opportunities on investments in equities, because we have a more resilient economy in this side of the world. Now let's move into some Philippine economic and financial indicators for the country. And so you'll see here, after the column for the years, Philippine Stock Exchange Index, PSEI. And next column will be PSEI percentage movement. So we saw that in 1999, by 2000, the market dropped from 2,1 to 1,400. It's a drop of 30%. This percentage will be reflective of the decrease or increase of the stock market. In 2003, the market went up 42% from 1,000 to 1,400. So that is the next column. Next column is Treasury notes represented by 10-year bonds. Next is Treasury bills, our 91-day T-bills. I will be showing you why that's important in a little while. Next is inflation. Year by year, these are year-end figures. Then you have the peso-dollar exchange rate. Again, this is the percentage change of the peso-dollar. So from 42 to a dollar in 1999, it depreciated to 50 to a dollar by 2000. That's a drop of 18% in 2020. So that's how you look at these numbers. Then on the last column, you will have GDP. Again, as I mentioned, prior to 2004, we hardly see any 5% growth in our GDP. And after 2004, when EWAT was put in place, hardly do we see less than 5% GDP. These two numbers here are because we were faced with the global financial crisis. And even then, we did not go into recession. All right, let's now take a look at some key lessons that we can take from this chart. I will first compare inflation and treasury bills. Because prior to 2004, a lot of people shied away from investing in stocks. And they were just investing in fixed income. And that is correct when you see interest rates are very high. Because why do you have to invest in stocks when you can make money on fixed income instruments, whether short-term or long-term, and yet avoid the volatilities, the ups and downs of the stock market? So for the longest time, people were just placing money in time deposits, renewable every 30 days, or treasury bills and treasury notes. But that was fine in the past because up to 2003, you will notice that treasury bill rates were even higher than inflation rate. That means over time, your money is growing, and not only growing, but even outpacing inflation rate. So you'll notice 1999, 8.9. Of course, even if you take away 20% final tax, that will still be higher than inflation. So you are really preserving, in fact, growing the purchasing power of your money by investing in fixed income instruments then. But take a look at this. Beginning 2004, when EWAD was put in place, even on a gross basis, before tax, the returns on treasury bills are now even lower than inflation rates, 7.8 versus 8.6, etc. down the road. There are only a few years where the reverse is true, where we had higher returns like 2015 on our treasury bills compared to inflation. So what does this mean? Yes, people thought that, well, I can sleep soundly at night because I don't want to be exposed to volatilities of the stock market, ups and downs of the stock market. So I will place my money in fixed income instruments. That was the thinking. That was fine up to 2003. But beginning 2004, yes, you are sleeping soundly at night, placing your money in fixed income instruments. But every day that you wake up, you can only buy less and less from your investments because inflation rate is much higher than what your investments are. So that is what was happening, and people were not realizing that because they were so afraid of the past where they saw substantial declines in the stock market. So here you notice just in three years, your funds were down by 50% from 1999 to 2002. So the lesson there is that you have to understand when you're investing in fixed income instruments, you will have to outperform inflation. This year, we're quite there, but if we take away final tax of 20%, that's only 2.4. Well, basically just at par, roughly, with inflation, just slightly below inflation. So that's the key thing. When you are investing in fixed income, you want to make sure you are outperforming inflation rate. Another key lesson that I said earlier, I showed you how markets are forward-looking. When we became investment grade, that was the time when interest rates started to move up. Again, a lot of people think that if you have a strong economy, therefore you will have a strong market, stock market performance. That is not, again, true. Because if we look at this period, the slowest GDP growth that we experienced in all these 20 years is here. In 2009, our GDP grew only by 1.5%. And yet, our stock market grew by the biggest percentage growth in the history of the country, measuring it from year end to year end. 63% growth in 2009. Again, you will have here periods of time wherein in 2016, GDP grew by 7.1%, and yet our stock market contracted by 2%. So you see here again, in 2013, our GDP grew by 7.2%, and yet our stock market grew by only 1%. Again, you do not equate growth in GDP in terms of a short-term outlook of the stock market. In fact, in 2009, I would highlight here that we had one of the least trusted presidents in the name of GMA, Gloria Macapagal Arroyo. So we will have practically every Friday during her term rallies along Ayala and Paseo de Rojas. And you will notice that 2009 was the year before the elections. Markets are forward-looking. They knew, the investors knew that the term of GMA was expiring by next year. And the leading candidates then were Senator Villar and Senator Aquino. And the market was ecstatic about having a change in leadership in the country. That's why even before the elections were held, the market started moving already. That's important to note also because as we head to 2022, next year the investors will also be positioning. If they would see that the next set of leaders based on SWS surveys and Pulse Asia surveys, that they will be good for business, then we don't have to wait for elections to happen, and then our market will probably also post a strong growth again. But on the other hand, if they see that the next set of leaders will not be as good or will not be any good, then you might be seeing more of a sideways movement of the market. Again, markets are forward-looking. In the same manner now, markets should be looking at what's going to happen by the second half of this year. What's going to happen by 2021? If we see, as IMF has forecasted, that there will be strong growth by next year, we will not wait for that. Markets will start discounting that and will start to be positioning for the recovery that we will be seeing next year, not for the troubles that we are currently experiencing, like what we saw in the past. Our economy growing only by 1.5% in 2009, and yet our stock market already was moving ahead That's how markets perform. We will not wait for things to turn rosy before markets turn around, because investors are positioning ahead in anticipation of what's going to happen and not what is happening right now. That's why you hear sometimes the adage, buy on rumors, sell on news. You know, when we know that something good is going to happen when this crisis ends, then you start taking positions now, and you don't have to wait for that period where we are in that situation. Again, a number of our clients right now, or even us, are quite edgy when we see huge losses. In 2000, 3 successive years of losses. Again, in 2008, a bit more than 40% loss. At that time, 48% loss. So this time, we're also seeing, well, 2018 and 2020 combined will already be a 40% loss. As we've seen in the past, when you have such losses, sometimes it takes more than 2 years. It could take 3 years. But if you stayed the course, then you are rewarded with returns that are very substantial here. Following 3 successive years of losses, some people would have given up. Oh, I don't want to be investing in the stocks anymore, and I would just go to fixed income. If you lost 60% or 70% of your money here, it will take you years and years, even decades, to recoup those losses. But in equities, you notice that companies bounce back because we are investing in companies, in solid companies in the Philippines. The big fund managers, Life is one of the biggest in the country. We'd only invest in the 40 or 50 top corporations in the Philippines because the others are very small companies. But of course, even big companies suffer declines in income. Even Berkshire Hathaway this year, in the first quarter, reflected 50 billion of losses. But Warren is not unfazed, and he will just move on because these are challenges. The key thing is to weather the storm and then move ahead into the years ahead. So again, I'm showing this because a lot of people are panicking, a lot of people are desperate at this point in time. The key message we want to bring across that we've seen this in the past, and recoveries are just around the corner. IMF is also forecasting good years in 2021, but still, our role as financial advisors will be to monitor developments, especially in the areas of vaccines and what they call as flattening the curve. If we're able to control this pandemic, then we should be going back to normalcy a year from now or even 2 years from now. But again, markets will discount and will not wait for those vaccines to be formulated. So again, as I said, I'm no economist, so I will depend on the key economic forecast for the Philippines. It will be NEDA. They're forecasting either minus 0.6% or contraction of 0.6% to a growth of 4.3% this year. And they even broke it down into impact of the pandemic versus transportation and tourism in terms of number of jobs that may be lost, percentage of GDP, and also forgone gross value added for revenues. So exports as well, remittances, consumption, and the Luzon ECQ. So they're forecasting that. So they're seeing, well, the economy can drop by 0.6%. So they're forecasting early on 6%. So 6 minus 0.6. That's the worst case scenario in their forecast for the full year. For second quarter might be worse than that, but for the entire year, they are forecasting this impact on the Philippine economy. So, but I'm not just depending on government, because sometimes government always presents a rosy picture. So I'm taking a look at another forecast for the Philippine economy. This is an Asian think tank. In the name of ASEAN Macro, it's ASEAN +3 Macro and Economic and Research Office, or AMRO, and they are expecting the GDP growth, I think, more aggressive between 4 and 5%, and this was released in April only. So which means they already knew the Luzon-wide ECQ. So we'll see how things turn out in the end of the year, but these are good to know figures in terms of even an external party having confidence in our ability to withstand the pandemic. So much for economic outlook. Now we will look at the outlook for our investments in bonds and stocks. You have on your screen the returns as of end of the year and as of end of April for 91-day T-bill rates, 364-day or 1-year T-bill rates, and bonds for 5 years, 10 years, and 20 years. So the distinction is that T-bills, treasury bills, will be for those not exceeding 1 year, and bonds will be for those in excess of 1 year. And earlier, I showed you the trend for 10-year bonds. So here, I'm showing you a snapshot also on year-end figures for 91 days all the way to 20 years. It's color-coded. When it's color red, it's lower than the previous year. It's important because we know that when we invest in bonds, when interest rates go down, bond prices go up, which means we make more money when bond prices go down over the short term. But over the long term, the reverse is true. When you see interest rates coming up, you will have bond prices coming down. That's very important as we review the returns for the last year. We saw very good returns last year in 2018 and very bad returns in 2018. 2018, interest rates rose, and so we had, for most mutual fund investments, VUL investments, and UITF investments, most bonds returned negative in 2018 because interest rates rose by a big percentage. And last year, we saw interest rates coming down. That's why we have very good yields on our bond investments. So again, going back to 2013, when we became investment grade in March, you will notice that across the board, practically, you see more greens except for the last 2 years, which means interest rates started to move up after it was declared that our sovereign debt is now on investment grade status. Again, markets are forward looking. I highlighted the figures for 2015 and 2020 as of April, month end, because it's very important when we look at outlook for the next 5 years. We will see here first on the long-term bonds, 3.9 last year. It's only 3.3% as of end of April. And on the long end, 20 years, it's 5.5 versus 4.4, which means if we invest in bonds, we will expect roughly lower returns because our starting point now is much lower compared to where we were 5 years ago. We have the figures, the return figures for 5 years ago invested as of last Friday, end of April. So that will become our benchmark into looking at what will be the bond returns over the next 5 years, assuming, therefore, that interest rates will be relatively flat. Here we saw that on the long end of the bond, interest rates even went down, meaning when interest rates go down, bond prices are pushed up. So our 5-year return is even helped by the fact that interest rates move down by a bit compared to 5 years ago. So we will see that later. On the short end, we will notice on treasury bills, it's even higher right now. So on money market funds, probably you might expect a higher return on money market funds within the next 5 years compared to 5 years ago. Okay, sorry. Here I showed you the gross before taxes. On the last column here will be net return. 3%, take away 20% tax, or 3 times 0.8 is 2.4. We will take away the final tax. So from 3%, the net return after tax is only 2.4. And on the 20-year bond, it's only 3.6%. Remember, what we will be getting will be net of taxes and net of management fees. One more thing I'd like to emphasize before we move to the next page is that, this year, we only see a slight difference between yields on the short end of the table, 91 days versus 20 years. Meaning, somebody who invests in 91 days makes a gross yield of 3% or net yield of 2.4. And somebody had to somebody who invests in 20-year bonds will only make net of 3.6% here, right? Okay, coming from the gross return of 4.5. The difference between a 91-day T-bill rate and a 20-year bond is only 1.2%. That is relatively rare. You will notice that at the end of this year, the difference between 20 years and 91-day return is 2%. All the way back to 2013, the difference is 4.7%. It's not good to be investing in long-term bonds when the yield curve is flat. You want to be investing long-term when you have substantial differences. For me, the minimum spread that I would take is at least 2%, preferably over 2.5 to 3%. So here it's almost 3%, 5.8 in 2018 versus 7.5. Here it's over 3%, 2.4 versus 5.7. So bonds right now, over the long term, are not looking too attractive because there's not so much to be made, because over the short term, the difference is only 1.2% on a net after-tax basis. But the key problem with investing in long-term bonds is that if interest rates rise, you will experience losses. So keeping that in mind, we will now try to estimate what the returns on the bond funds will be moving forward. So again, on the last column will be the net after-tax returns. We will transpose that in the next slide. These are the net after-tax returns shown in the previous slide. We will take away the management fee. So our target returns for bonds will be 0.9 to 2.1%. Some of you, especially the newer agents, might think that, well, but last year we made good. We made double-digit returns on bonds. That happened because interest rates went down. It's like a seesaw. When interest rates go down, your bond returns go up. And when interest rates go down, your bond returns go up. So you have to be very careful. So this is not to say that, you know, when we illustrate our VUL right now, it's 4, 8, and 10%, that we can still make 4%, and that 4% illustration is low, 8 is medium, and 10 is high. We can't even make 2%. That's my fearless forecast in the next 5 years. So am I saying investment in bonds is bad? No, because some of our clients are really risk averse, and so bonds will be best for them. But understanding that we will not create an expectation from our clients that 4%, 8%, or 10% might be doable given where interest rates are at the moment. So yields will likely be in this vicinity, 0.9 to 2.1. So my forecast will be from 0.5 to 2.5, because if interest rates rise, it might be even lower than 0.9. And if interest rates fall, it might be even higher than 2.1. So my fearless forecast that long-term yields on bonds, if you invest in bonds right now, 5 years from now, it will be reflecting a compounded growth of roughly between 0.5 and 2.5. My mean expectation is about 1.5 to 2% expectation of returns for bonds over the long term. Here are the bond fund returns. I don't have the figures for VUL, but we have most of our competitors here as well, and all the fund managers basically invest in the same instruments, government securities, and sometimes for corporate loans. It's a matter of some people are investing in longer term bonds and others in shorter term bonds, depending on their outlook on the interest rates and the outlook for bond investments. So over the long term, the returns have been only not even 3%, despite the fact that some are showing double-digit returns 1 year as of April 30, again, because interest rates have come down. But long term, the returns have been below 3%. That's why I showed you earlier that bonds are lower right now in terms of yields, lower than where it was 5 years ago. That's why I'm saying our returns within the next 5 years will be lower than what we've seen in the last 5 years. So again, a caveat on investments in bonds. The proposals should not be used to create investor expectation on future return on bonds. Yes, we had good returns last year because interest rates went down. Long-term returns on bonds from where we are right now will not exceed 2.5%. Obviously, if interest rates will rise from 4% 20-year bond to 5% to 6%, then moving forward the returns might be better, but you will have to experience first declines if interest rates will go up. Now, having said that, we'll take a look at the outlook for stocks. Outlook for stocks in this period of pandemic. Here is a table of price-earnings ratio. These are so many numbers on the screen, and where do I get that? Any one of you can just download that. Just Google BSP, Bangko Sentral ng Pilipinas price-earnings ratio, and they will take you to their statistics link, and you can just find their price-earnings ratio. You can click on it, you can download it in PDF form or in even Excel form. And you know, the highest our price-earnings ratio would have reached 28 times prior to the Asian financial crisis, and the lowest is 8 times. Since we became investment grade in 2013, we've peaked at the 22, 23 times. and the bottom before this year was about 17, 18 times price earnings ratio. Some of you might be relatively new, may not understand what price earnings ratio means. If a company is earning $1 billion a year, let's say, for simplicity's sake, 1 billion a year, some people will be willing to pay 10 billion, price is 10, earnings is 1, so that's 10 times price earnings. So somebody who invested in that company, if it's only 10 times, 1 over 10 is the earnings. You invested 10 billion, you make 1 billion a year, so you make 10%. So normally you will see an average about 17 times price earnings ratio. So we'll give an investor about 4 to 5% return on their investments. So, but this doesn't make sense much. We just see this number. So you might ask me, when is it low and when is it expensive? This chart does not tell you anything. We know the average is 17. We know the bottom before this year, when the time we became investment grade in 2013 was 17, 18. So we throw away the past. If we look at the present, beginning 2013, and we look at this number, that's why some investors have been misled with the fact that early on or late last year, market was already trading cheaply because we were at 17 PE. So we'll go back to that particular premise later on. On our next slide, what I did was chart the 10-year return on the stock market, chart the graph of the PSEI 10 years ago. So someone who invested in the market 10 years started from here about 3,000. As of last Friday, it was 5,700. The return would have been 5% net after tax. That's still better than placing money in, of course, because some of our investors place money on a one-time basis, but some are investing regularly. And I'll show you how investing regularly performs as well in terms of returns. But this is just an investment, a single investment 10 years ago, returning the client 5% compounded annual growth rate in the last 10 years. And what I did here is that, okay, we know the PE ratios here coming from that chart, and I just placed it at the peaks, the bottoms here, all right, of the chart. And what we will notice is that since we became investment grade, when our PSEI hits 22 times, 23 times PE, the market tends to correct back to about 17 and 18 PE, etc. So notice, again, I mentioned earlier that markets are forward-looking. Some of you might have been present during my talk, April 2013. We were at AIM and there were 2 speakers. I think there were more than 300 agents of PruLife UK in 2013 at AIM. The other co-speaker that I had was April Litan from CitySec Online or Call. And remember, we just achieved our investment grade status at the time. And she was saying that, you know, we are on a sweet spot and they expect the market to hit 10,000. That was CitySec Online's or Call's forecast in 2013. This is already 2020 and our index has not reached 10,000. And in the same forum, I said, I expect the market to go to 6,000. In fact, it went down even lower at 5,500. And I remember the audience were perplexed. How can 2 presenters have two way different views? One was saying 6,500, 6,000, and the other one was saying 10,000. But, you know, because I was looking at the fundamental reasons. Yes, there was so much excitement for the Philippines achieving investment grade, but also because markets anticipated our achieving investment grade, interest rates went down, the stock market went up. And so after it was announced, again, buy on rumors, sell on news. It was the news that investors sold into. And so the stock market went down to 5,500 here. Again, we saw that rallying again in the next year, in 2014, only to hit a speed bump again when it reached PE of 23, and it went down again. So you'll notice here that market, you can determine from past PE that when it hits 22, 23 PE, then you're near the top. And when it reaches 18 and 17, you're near the bottom. So people might be thinking, what about here? Why did we break through? The key difference that there were no external events impacting the local market during this time. The next slide I'll show you is that what happens to the Philippine Stock Exchange Index when there are external events affecting our economy and our financial markets as well. The next slide will show that. This is a longer term view of the Philippine Stock Exchange Index coming from the late 80s we will see that during the Asian financial crisis, our market hit a low of 8 price earnings ratio, 8 PE. And during the last global financial crisis, the market hit a low of 9 times PE. So we'll notice we are, when there's a global event, our markets really dropped very low in terms of PE ratios. In the last time when we saw 4,000, the PE was 11 times PE. So are we saying that the market can go lower than 4,000? Possibly, but again, if we're not able to contain this pandemic this year. If we're able to contain that, then we will be slowly going back to the normal times, and we should be seeing some growth in the year ahead. Again, that's why it's very important for us financial advisors to stay tuned to our IMD for their discussions on what's happening outside the country and also in our local financial markets. And for you as well, you can just download the apps, Bloomberg app and CNBC app from your smartphones, and you will see globally what are the events that are important to understanding financial markets. So again, some people were misled by the fact that PE ratios were 16, 17, 15, but this is a global event. That's why we're seeing very low price earnings ratios. Again, markets anticipate, even before we had the crisis, in February, we only have a single case of COVID-19, and yet our market dropped dramatically because the expectation was that the numbers will explode and economies will be in lockdown mode, and so the impact will be very negative. Again, to show you we don't have to wait for the events. The numbers are still increasing right now, but market is somewhat stabilizing because market is now trying to look for what's going to happen next. Are we over the hump already? Have we seen our curve flattening? And so we are taking more control, and that workers are slowly going back by end of or by middle of this month. All right, just to remind you that investing in stocks, because I've been investing since 1986 for 34 years, and I've seen through those ups and downs. In fact, some periods it takes a longer time. Here, look at this. Market at 3,300 in 1994, and 9 years later, it's 1/3. The market dropped 2/3 over 9 years. All right, but people who got discouraged were not able to ride the next up move of the market. That's how investments are. One of the smartest investors in the Philippines is Henry C. He would start constructing malls during crisis years. The big malls were constructed during crisis because, well, labor is cheap, steel and cement prices are cheap, and that's how you benefit from crisis. In every crisis, there are opportunities. Now, that's so much about fundamentals, understanding how cheap or how expensive we are in terms of price earnings ratios. The next thing I'll show you is that combining fundamental and technical analysis. So, sometimes you watch on television, you read on the papers, investment analysts talking to you about technical analysis, support and resistance levels. It's as if that's exclusive to investment analysts and very highfalutin. How do they come up with those numbers? I will show you that even grade 1 students could perform technical analysis. The key thing is just to start identifying 2 bottom points in your chart. Okay, sorry. And then these are 2 points in mid 2013 and in early 2016. And then connect that with a parallel line. All right, so with a straight line, sorry. Next, we look at the point before the bottom here. That's early part of 2013. That's the point. We draw a parallel line. So that's a parallel line. And this will be your channel, which means you expect the stock prices after you've identified these 2 points by mid 2016. What this chart is saying, well, these are your resistance and these are your support levels. What does that mean? Think of this as a 7th floor. There's a song, Heaven on the 7th floor. So I'd like to use that example. But our 7th floor is not horizontal. It's slightly inclining upwards. So if you drop a golf ball from here, when it reaches the floor, it bounces up for a golf ball. When it hits the ceiling, sometimes it punctures through the 7th floor, the ceiling of the 7th floor. It goes to the 8th floor. If it's strong enough, it will take you to the ceiling of the 8th floor. But if it's not strong enough, it bounces downwards again, back to our floor, and then back to our ceiling on the 7th floor. And so you have this channel. So early on in the year, I was saying that if we break through 7,000, expect the market at very low levels, because now we're going to the 6th floor. All right. How do we determine that? It just so happens that our points, our 7th floor that we term here, this area, passes through 7,000 and 9,000 here. And so what we're going to do is, if 2,000 is the length of one floor, our next floor will be at 5,000 and the next floor will be at 3,000. Those are 2 points. We do parallel lines again, and now we're trading here. At 5,700, we are on the 6th floor. If this is our 7th floor, we are now on the 6th floor, which means our range will be 5,000 to 7,000 roughly, right? But that number is moving over time. Again, this is saying our golf ball just punctured our floor on our 7th floor. That's why it went down all the way to our floor on the 6th floor, even went down to the 5th floor, and then bounced up. So right now we're here. Okay, we're now here on our 6th floor. We expect trading in this range, and most likely, if the economy goes back to normal process ahead of time, we'll even go back up to our 7th floor, ultimately to our target of 10,000. A lot of analysts have set targets of 10,000, but for me, that is not still impossible. I think, we handle this pandemic very well. Maybe in the next 3 or 4 years, that's the only time we will reach 10,000. Not earlier than, the forecast of CitySec before was that we will hit it when we hit 2013, before after investment grade. So I expect 10,000 maybe, again, if we handle the pandemic very well, on a global scale. So if we're here, if we pass through 7,000, more confidence that we are headed next to over 9,000 in the months ahead. And so sometimes you have both price earnings ratio, fundamental and technical analysis pointing to the same point here. So here, just before 2019, we saw also in our forecast here that was also our bottom at 18 times price earnings. So sometimes when you see those numbers converging, it gives you more reason to be very optimistic about how you're using technical analysis and fundamental analysis in timing your exit or entry into your investments in stocks. All right, so as of now, we have support level at roughly 5,000, but that support level increases over time. And our resistance currently is about 7,000, but again, that increases over time. So we are expecting market to be moving upwards. But again, if we break 5,000, then we could possibly go back to 3,000. In any case, the downside will be much lower than our potential upside, which is all the way here, approximating 10,000 over the next 5 years. Here are the stock returns as of April 30. Market is down 27.8%, and yet most funds are also down on a year-to-date basis. This is even lower than the index 7 years ago. So inescapable, whether you're investing 1 year, 3 years, or 5 years, your returns are all negative. So here it's -10, -5 here. So that's -10 per year, mind you. So somebody who invested with Atram Philippine Equity Opportunity Fund is losing 10% per year for the last 5 years. So that's on a compounded basis, roughly about 55% loss in the last 5 years on investment stocks. But again, businesses do not stop when losses are made or when their incomes drop, but they recover over time. In fact, when there are crises, the smaller players, the weaker players drop down, and in the end, you will have the bigger players even becoming stronger because there is less competition as the economies turn around because there are lesser players. Here's a chart that follows the market emotion cycle of investors, average investors. And they go through a period from optimism, people get excited. As markets go up, they become very thrilled. Wow, I am very smart. I got the market on a rising tide. And then everyone gets very euphoric. And clearly, for me, this was a time that the train low was passed. Build. I've seen a number of my friends on Facebook who are financial advisors saying that, the train low has been passed before you get left behind by the train. This is now the time to invest in stocks. How wrong could they be? Because the price earnings ratios were already on the high side, and I was saying that I think it was an opportunity to be selling the market, but that's the normal experience and sentiment of the average person. They're very euphoric, and then market starts to come down, and then even fund managers sometimes they are in denial. They're saying markets will go up because we have a strong fundamental, etc., etc. Then the sentiments turn to fear as markets come down some more, to desperation, to panic, to capitulation, to despondency. The maximum point of financial opportunity is when markets are low, because the way to make money in investments, buy low, sell high. Especially the ladies, when they spot bargains in buying clothes, shoes, and bags in malls, when they see the four-letter word SALE, sale, that's the time they spend time to buy clothes, bags, and shoes. You should use that sense of spotting bargains in financial markets. You should be buying when the financial markets are low, because the common sense is that a lot of people get very thrilled and euphoric when markets are coming up. But markets go in cycles. Even economies goes in cycles. But they're not one and the same. Markets anticipate. So our market has dropped rapidly in February and early March, even before we saw these huge numbers of cases with COVID-19 in the Philippines, because markets anticipate. And when we see that the market or the curve is flattening, and some developments, positive developments, are in the area of the vaccines, then we will also be seeing the markets rising rapidly. I think we are somewhere here. We've moved past panic and capitulation. I think either people are here, or we probably have seen the worst last March 19. But who knows? I'm providing that something, if this takes a longer time than expected, if the pandemic remains with us for over a year, then there might be some ways to go for our market as well. But knowing that if we're somewhere here, the upside potential going back to euphoria is very high. And even if we're starting here right now, the market might still come down. But the losses, the possible losses, are much smaller than the possible upside as we move ahead. Remember, investing is for the long term. We don't sell insurance policies for 1 year, for 3 years, for 5 years. These are long-term contracts that extend over lifetime. So we don't mind volatilities. In fact, we should be adding positions as markets come down. Here's the famous quote of Warren Buffett, one of the most well-known, if not the best well-known fund manager or person who make investments in owning companies. Be fearful when people are greedy, and be greedy when people are fearful. He's pointing out to the fact that when people are euphoric, people are being very greedy. They want to buy all the funds that they can invest in stock markets, and that's a time to be fearful, as a wise investor says. And when people are fearful, like the period right now, he's saying this is the time to be greedy. We may not hit the bottom anytime. No one knows when the bottom will be, or if we've seen the bottom, but we just have to know if we're buying at a low price based on support and resistance levels on a technical side, and based fundamentally on a price earnings ratio. Both measures are saying we are on a cheap basis, or at least not on an expensive basis at this point in time. So there are opportunities at this point in time. But for me, I don't want to use the term greedy. It doesn't sound good, especially looks like you're taking advantage of people who do not know much on investments. I'm rephrasing that. I have my own words for how we invest in markets. When people are euphoric, again, referring to the table that I just showed you, be kind and sell your shares. So they so desperately want it anyway. And when people are despondent, be kind and buy the shares. They so desperately don't want it anyway. A key rule in investing is be kind to others. Again, you might be experiencing at this point in time clients who are angry, who are despondent, who are panicked, want to sell the shares. Our role as financial advisors is really to enlighten them of what happened in the past. After dark days, you will have brighter days. When the going gets tough, the tough gets going. We are number 2 in the industry right now. And these are periods where we can see who will take advantage of the present situation. There are opportunities out there. We just have to handhold our clients, explain to them what's happening and what lies ahead of them. This talk is part of that, to address the concerns that you might have, so that you can communicate this as well to your clients. As I said, in any investments, there are key risks. And so what are the key external and internal risks as we see it at the moment? Externally, we are seeing basically a global economic slowdown moving forward, or recessions, more likelihood of slowdown or recession, again, because the bigger economies, the developed nations, have very high debt ratios and even high fiscal deficits as a percentage of GDP, much higher than the economic growth, which means over time, they are piling up more and more debts, and their debt ratios will be increasing over time. And increasing debt ratios tend to point to even slower economic growth. Even at this time, when interest rates are lower in that side of the world, and then they're seeing already very slow economic growth. What more into the future when they have even higher debt ratios, where more and more of the revenues are being used to service their debts. So right now, global economies are on a near halt. This is uncharted territory, something the global economy has not seen till the early 90s with the Spanish Spanish flu. And then we have rising unemployment rates. Even NEDA is forecasting some losses for us. New norm of higher debt ratios in developed markets. Increased likelihood of recessions. As we know, this is connected with high debt ratios. Extremely low interest rates, leaving many countries little leeway in restarting their economies. What do I mean by this? Extremely low interest rates. First, we will take a look at the jobless claims. This is the data. The US compiles data on weekly initial jobless claims because the US provides unemployment insurance. For us, SSS only provides us with retirement insurance, paternity benefits, death benefits, and hospitalization benefits, also through PhilHealth. For them, they have, in addition to those, they have unemployment insurance. So on a weekly basis, these are compiled. And you notice the numbers are very low here. Normally, the peak already that they had experienced prior to this year was about 660,000 jobs lost in 2009 during the height of the global financial crisis last time. But this number, they almost hit 7 million in a single week, by the way. So this chart is really way off the mark in terms of the past, nothing they've seen since 1965. That's 55 years. So we'll take a look at that. As of last week, third week of April, they still don't have the full fourth week of April results. That will be coming out Thursday this week. 3.8 million jobs were lost in the third week of April in the US. This is US data. And then we will zoom in to what happened in 2007 to 2015. It took them 15 years for the economy to get back the losses in jobs that happened during the last global financial crisis. So it took them 8 years. So we'll take a snapshot of that in the next slide. So here it is. 2007, job losses in the US were about 300,000, averaging roughly per month, a shade over 300,000. And then we know there was collapse of Lehman, bailout of Citibank and AIG. Job losses hit 600,000 jobs for that week alone. By the way, these are weekly numbers, okay? And it took them all the way to 2015 before job losses for the week stayed below 300,000. And now we will take a look at the year to date, starting this year, 2020, January 2020, all the way to April, third week of April. They had steady job losses, about shade above 200,000, and then by March it increased to 282,000. The following week, 3.3 million jobs were lost. The following week, it was 6.8 million jobs, 6.6, and then last week it was 3.8. Just in the last 6 weeks. That's correct. Just in the last 6 weeks, 30 million jobs have been lost. Remember, Bank of America earlier said they're forecasting 20 million job losses just the last 6 weeks. That has been exceeded already, as 30 million jobs have been lost. And I think we will see more job losses when they come up with the end of April week. So yes, we are experiencing the worst financial crisis in the US, and these numbers are being replicated in most countries in the world, except they're compiling data because of their unemployment insurance benefit payouts. I also mentioned that US interest rates are very low in terms of federal fund rates. What happens that when they start feeling an economic problem, economic contraction, they bring down interest rates. Like in 2001, they had the dot-com bubble and also the 911 attacks. And so they brought down interest rates. Why do they bring down interest rates? Why does their central bank or their Federal Reserve Board bring down interest rates? Because hopefully more people will borrow money to buy houses, to buy cars, to restart their economies. And also more companies will expand their businesses and hire more people again, all helping to restart the economy. They will bring down interest rates aggressively as the need rises. And when they feel that the economy is starting to normalize, they bring this back up. Normally, it's about between 4.5% to 5.5%. That will be the usual range in normal times. That's why you see here around 4.5% to 5.5% in normal times. Their federal fund rates will stay. But then the last global financial crisis struck, and they brought down interest rates aggressively again. All right. Now to even lower rates than before, than where it went in 2003. They brought it down to near zero at only 0.25%. Not only that, it stayed there for a long time, going to year-end 2015. In the past, when it hits bottom, quickly it rises very rapidly and goes back to our usual 4.5% to 5.5%. This time, it went to lower level, 0.25, and it stayed there for almost 7 years, 2009 to 2016. Not only that, when they started to raise interest rates in the past, it was very rapidly. Okay, sorry. It was very rapidly. This time, it was being raised at a much slower rate because their economy has not really been able to gain a foothold and to restart. As we've seen, the economy was only growing at 2.2% in the fourth quarter of last year. So it was not a situation where they feel comfortable that they can raise interest rates back to the level of 4.5% to 5.5%. And very quickly, when the pandemic started in late December in China initially, they brought it down almost a straight move back to almost 0.25. So you see, this is how their central bank, represented by the Federal Reserve Board, is reacting in terms of what's happening right now. Very rapid decline, and hopefully to give the economy a much needed push. So we've seen that there are three major global events that have impacted our local markets and even our economies in the last 25 years. And so we've seen that in the Asian financial crisis, our market dropped by 70% from its peak of 33 to 1,000. During the last global financial crisis, 2007, 2009, our market dropped by 51% from 39 to 19 on the bottom. And this year is another event impacting our economy from the outside. Our peak was reached early on in 2018. So if we put this at 2018, it's almost roughly 10 years when markets go into cycles. Peak at 4,000 or 9,000 in January 2018, and bottom last March 19 at 4.1. This is 54%. While this could have estimated it's somewhere in between, but the earlier forecast that we are seeing the worst crisis since the last global recession in early 1900s or since 1940s. But again, the major difference is that this is not a financial crisis. This is a health emergency crisis, a pandemic issue. If we get a handle of this, our economies will be going back quickly. But if it takes a long time, if we have a wave 2, if we restart the economies very soon than what's safe, we may experience a wave 2. What does wave 2 mean? We all know that in the Philippines, it just started with one case in February. And now a big part of our economy is on lockdown. It's on enhanced economic quarantine, community quarantine. So what we don't want to happen is that we go back to normal times and then we see another increase in the numbers and we have to lock down our economies again. So it's a balancing act. It's very difficult for leaders right now of countries, governments. How do they balance the concern for the economy and health issues? But again, my belief is that This time, it should be the health professionals who will dictate when it's safe for workers to go back to work. So in our country, it's going to be gradual release of workers. The more important ones go ahead first, and then on a staggered basis, we will have wave 1 going back to work, and then wave 2 until hopefully we achieve capacity for our hospitals, achieve also improve testing facilities and number of facilities as well. So we can only speculate how long this will take. If we are able to control the virus right away in the second half of this year, then for all intents and purposes, especially if the next set of leaders by next year will be favorably viewed by investors, then will be a strong market next year and even later part of this year. Again, some people are very quick to mention that in the past, when markets go down, in the last since 2013, when markets went down, it took very quickly for markets to go back up. But sometimes, like what we hit right now, 5,000 index, it was last seen 7 years ago. Here at 4,000 index, it was last seen 10 years back, the first time it was hit there. And sometimes, it could take as long as 16 years. If our index will go back to our fifth floor, the floor of the fifth floor, which is 3,000, then this one would have been back here 26 years, and we were still at 3,000. I don't want to create the perception or the expectation that bear markets could just last only 7 years or 5 years. In fact, the Chinese stock market reached its peak in 2007, and the Chinese economy has been growing at since 2007 for the last 13 years, averaging more than 8%. Of course, last year it only grew by 6%, despite the fact their market is still down 50% right now compared to its peak in 2007, 2008. So that's over 12 years right now, and their market is still down 50% because you have to understand also the fundamentals and the technical view. The Japanese stock market, we've seen earlier how they have over 200% debt to GDP ratio. Their market reached a peak in 1988. Their market right now is down more than 40% from 32 years ago. That's correct. Down more than 40% in 32 years. Because again, it was coming from a very high level. The price earnings ratio were approaching 3 digits at that time. And they thought, it was a special market, that they were exempt from valuation standards that are being practiced in other parts of the world because, coming from the war, their economies were very strong, recovering from the war. And Japan was noted for producing very high quality goods. Their exports were doing very well. And yet, 32 years later, the stock market is still down over 40%. Again, interest rates are still very low in Japan, and they could not restart their economies because of their debt ratios. So locally, this is a key risk. Obviously, COVID is not just an external risk, but also a local risk, as we are on lockdown. As we move to May 16, even Bacolod, Iloilo, Cebu, and Davao are also in enhanced community quarantine. We still expect a slowdown this year. Hopefully, we will get back to our path to over 5% growth by next year. Hot money flows. What do I mean by this? Our markets are very small. We have seen our GDP is only 1.5% of that of the US. That's why our local market is dictated by what foreign investors do. When they buy in a big way in Philippine equities, our markets go up. And when they get out of a market for one reason or the other, our markets go down. And when nothing happens much. They early part of the year, they may be buyers. By the end of the year, they're sellers. If by the end of 1 year, they hardly bought nor sold the market, nothing much happens to our markets. Again, over the long term, foreign investors still dominate the Philippine market, and they dictate where our markets move. And I'll show those numbers in a while. I believe we have an overheating real estate market. Prices have gone up rapidly, and so we might be seeing that real estate prices might be topping out or might even be showing some declines. There was even a study by Colliers that they're saying that they can expect the market to come down between 10% and 15% by the end of this year. Political risk. I mentioned this earlier. In 2009, we saw the stock market gaining rapidly, 63% growth in 2009, even before we had the new president, because investors are forward-looking. Okay, so if they see that the next set of leaders will manage the country, favoring also businesses, then we will even be seeing rapid economic and financial market growth next year. Low interest rate is a key risk for bond holders because people who retire normally would expect to put their money in fixed income instruments. And right now, it will be paying very low returns. After inflation, not much to be made, but still, it's still okay compared to people who are not really used to seeing huge losses. So still a good investment, but it is challenging for our retirees because normally the retirees will be placing a lot more money in fixed income instruments. And right now, the returns on those fixed income instruments are on the low side. All right, this is what I was saying, that our market is dictated by what foreigners do when they invest heavily in the market, net foreign buying or selling. What do I mean first by net foreign buying and selling? This means that when a foreign broker buys, let's say, 1 billion of PLDT and sells 1 billion of Globe, so they switch. There's no net foreign buying or selling. It zeroes out. So what I do is that I add up all the buying and selling for the period, for the day, and net that out with all the selling. So that is how we determine net foreign buying or selling. These represent the flows into our market, whether inflows when it is positive, net foreign buying, or outflows when this is net foreign selling. So we'll see when they come in heavily, like in 2012, 110 billion, markets up 33%, 2014, 53 billion, 23%, 2017, 54 billion, 25%. Again, this was when the trade law was passed towards the end of the year. See, they placed a lot of investment before it was passed. But after the passage in December 2017, they sold out. Again, buy on rumor, sell on news. Market is forward-looking. News that we hear right now is already passé. All right. So what's happening on coronavirus right now has been discovered. All people knew that. The wise investor already got out early on when they saw how it impacted negatively China and it was starting all over the world. People started selling already. But because our markets are also small, they could not just pull out in one single day. It took them some time. So we noticed in periods where they did not participate actively, or by the end of the year, they netted out their buying and selling. In 2013, market hardly moved, only moving 1%. Again, in 2016, slight decline of 2%. Again, last year, just slight decline, slight up move of 5%. Year to date, just 4 months, they already sold 51 billion. Of course, they will come back later at some point in time because they know the markets in Asia will be recovering faster. And some countries in Asia will not be going into recession like what we saw in 2008. Our economy did not go into recession. And so 2009, even when our economy dropped by or increased only by 1.5%, we saw a huge recovery of the stock market. I think something like that's going to happen as long as we are able to contain the pandemic. Having said that, the risks, the outlook, and the economic environment, we now come to the last part of my talk, which is about investment strategy. As I mentioned, I will be presenting to you my short-term view and my long-term view. These are my own views, which are attuned to my risk profile. I'm a very aggressive investor, but still and all, despite the fact that my risk profile tells me I'm aggressive, my views are for the long term, I'm okay seeing my investments go down substantially, and I am knowledgeable about financial markets, I would still have position in bonds, not just go all in stocks. It will depend on my outlook of financial markets. These are my own views, which are attuned to my risk profile. You have to adjust when you talk to your clients or when you're evaluating your portfolio, address your concerns about KYC on your clients. Are you okay with your current portfolio? Also, let's move into our short-term strategy. A review of our portfolio allocation is the first thing we must do. Because some of our clients, when they bought from us, it could be 10 years ago, they're nearing retirement right now, they might need some adjustments. Also for ourselves, some of us would have answered the question, are you okay with seeing returns drop by 25%, 15%? Some are okay with 25%, but were they still okay when they see markets drop by 40%, 50%? So, are they really aggressive investors and they can weather the storms? Because some people, they said we're okay to see 25%, but they start calling you when markets are down. You remind them that you had sold to them a fund which was not inconsistent or which was consistent with their KYC. They answered you before that they were okay to see their funds drop by X%. So, and investments are always for the long term. Remind them again, these are investment in big corporations in the Philippines. They have been successful in 50 years, some in 100 years, PPI, for instance, over 100 years, and they will continue to be successful into the future. These are challenging times. They will overcome this, and over time, their incomes will also be increasing. In fact, the stronger players will become even stronger after crisis years because the smaller players normally will not be able to continue, and their market shares will be absorbed by the bigger players. You might be seeing more consolidations as well. I would also advise that you review your cash reserves for any unforeseen events. These are uncharted waters. We don't know how long this is going to last. Are we going to see a wave 2, or will we be over by second half of this year? Because the estimates of epidemiologists that realistically it will take a year and a half to 2 years for a vaccine to come out. They are fast tracking the review and testing, but they say it will take a longer time because you will have to test that there are no side effects. I remember some testing was being done for the vaccine for malaria, and there were side effects. No, if used aggressively, there could be side effects. So normally, it takes optimistically already 1.5 years to 2 years for vaccines to come out. So this might take a longer time, and it will be good that all of us will have reserves of at least 6 months. Let's not just be optimistic that this will be over in the second half of this year. It's also important that we monitor movements in interest rates. I mentioned to you that the spread between 20-year bonds and 91-day T-bill yields at the moment is very small. On a net after-tax basis, less than around 1.2%. I would be aggressive investor in bonds when I see that I get compensated by at least 2%, preferably 3% in 20 years compared to 91-day T-bill rates. But it doesn't mean that bonds are not good investments because, again, some people are conservative investors, and that will match up to the current risk profile. Hopefully, down the road, we will have REITs, real estate investment trusts, and these will be added options for us. That's why also for us in the Philippines, for us in True Life, we are exploring investments also in bonds in Asia and also in equities outside the country because we are expanding our horizons. And we are expanding to those economies which we see will be growing much faster than the advanced economies. Start gradually accumulating equity funds. Again, I told you I'm a very aggressive investor, but even I have placement in bonds at this point in time. Significant drops in PSEI may be taken as an opportunity to further increase PSEI allocation. That's a short-term view. We will now move to the longer-term view. Very important for us financial advisors to keep abreast of local and global developments. You have fact sheets that are given out regularly. Read them, please, and try to understand. If you have questions, when IMD conducts its sessions, ask those questions, or even you can email them your questions if you don't understand the fact sheets. As I said, you can review news, business news. Locally, you can watch ANC, and then internationally, as I said, you may download Bloomberg app or CNBC app. Those are key applications that can really bring you up to date in terms of business news as it concerns COVID, GDP growth, and interest rates, not just locally, but globally as well. Also impacts on economy in EU, in US, and in China, how their economies are performing. Because still, as the saying goes, if the US economy catches a cold, the rest of the world catches pneumonia. Obviously, over time, that was more relevant in the Philippines 20 years back. Still and all, at this time, we are still dependent on them, although our dependence has been much lower than what it was 20 years ago. So you see, during the last global financial crisis, it started in subprime in the US, and yet our economy was affected. Our stock market dropped by 48% in 2008. So you still have to understand that economies are interconnected, interlinked. So we can't say that, well, you know, it's malayo sa bitukan natin yan, so we will not be affected. That's why, as financial advisors, you will have to stay tuned to local and global business developments. Local politics, I told you, will be very important, especially by next year, as we transition to the next leadership. Company earnings, how are company earnings coming out in the first quarter, in the second quarter? We will throw away all the forecasts right now. Anyone, the brokers who will be doing forecasts for the year end of company earnings, it's so difficult. They have not really measured the impact on earnings of pandemics. This dates back to the early 1900s, where people don't understand. The economists that we have right now are not used to forecasting the impact on earnings of such closures of economies due to pandemics. So I am not one who will give a forecast on what the year-end number will be. In Q&A later on, maybe you'll ask me, what's my forecast for the end of the year? I don't give forecasts. That's good for newspapers, but not good for financial advisors. Why? Because we saw how it's impacted by the movements of foreign funds. So it will be affected by earnings of companies. And no one at this point in time will be able to get really a good review of what's going to happen to foreign fund managers buying or selling activities or company earnings. So I'm not one who's going to be following almost everyone by saying my forecast for the end of the year is so and so numbers. Forget about that. Your role as financial advisor will be to understand if markets are cheap or markets are expensive. You understand as well where the psychology of the investors are. Are they near the maximum opportunity, as what we've shown earlier? I think they are at this point in time. So those are the key measures we have to understand as financial advisors. Over the long term, I've showed you that where interest rates are right now, I don't see returns on bonds being over 2.5%. And you have to monitor the spread between the 20-year and 91-day T-bill rates. Where do I get those data that I showed you earlier? You can download PDS, Philippine Dealing System. Every single day by 5 in the afternoon, they'll show you the interest rates. 91 days all the way to 20 years, even inclusive years. I just showed you 5, 10, 15, and 20. It will show you 6, 7, 8, 9, 10, etc. It's eds.com.ph, Philippine Dealing System. If you forget the www.pds.com.ph, this Philippine Dealing System, and you'll get those numbers on a daily basis. Equities provide good long-term value. As I said, it's now at 5,700. If we're on the 6th floor in our discussion earlier, the upside is 7,000. If we get a handle of this pandemic, we're even going to 9,000. The upside is even much more than the downside. Why do I say that the downside is only 5,000? Because my strategy is, if it breaks 5,000, I will sell first, hoping to buy much lower at maybe 3.5, 3.6. I don't expect to buy at 3,000 because, you know, I know even if our market will go down there, I will be the downside will be very low already if I was buying at 3,500. I don't expect at this time to go down below 5,000. But if it goes down there, I'll sell first, and then. But if it doesn't go near 4,000, I'll buy back around 5,000. So I have a strategy in terms of my managing my equity investments. So that way I minimize my downside and I maximize my upside. So here, if I ask you to throw a pair of dice, if I tell you, you know, if you throw an even number, I pay you 1,200. If it comes out odd, you lose 700. Some people will say, I don't want to lose even a small amount of money. So some people say, I'm safe, I will go just to bonds. But other people, well, it's almost 2 times, 700 to 1.3. But even the higher side is that if we break 7,000, then we're heading towards 9,000 and over. So the upside might even be much, much higher than the downside at 5,000. Alternatively, for most people, you know, they just have to understand investments are for the long term. There are times when markets are strong and post good returns. We've seen that in our table earlier. Sometimes it takes 3 years, sometimes it takes 1 year, like what we saw in 2008. The market was down 48%, but the following year it's bounced back quickly at 63%. So staying the course is a good thing for long-term investors. You know, if they bought a product to us that's payable for life, just keep on investing. You know, because as long as the economic fundamentals of the country remain intact, the valuations of the companies, they're not expensive, go ahead and stay the course. Make sure your portfolio is attuned to your risk profile, objectives, and personal circumstances. I used to say that, you know, I have a rule of thumb, 100 minus your age is the proportion you invest in equities. But people have been living longer, so, and interest rates have come down dramatically in recent years. So I've changed that to 120 minus your age is the proportion you put in equities. When interest rates are normal, we can go back to 100 minus your age. What do I mean by that? Somebody who's age 20, 120 minus 20, your age is 100. You can go up to 100% in stocks. If you're age 60, about to retire or at retirement already, 120 minus 60, you play 60% in stocks. In the past, it was 100 minus 60 because you still make money on bonds. But when returns on bonds are even lower than inflation, then I don't want to have a significant portion in bonds. I will increase my portfolio waiting for my equity investments. Peso cost averaging, that's what it's called by staying the course, allows investors to buy a lot more shares when the NAVPU or NAVPS, as the case may be, is down. So it's the next best thing to timing the market, as long as the investments are for the long term. In insurance, especially, you know, if you die and you had made a single pay product, bought a single pay product, you are bound to make money because you have guarantees that the sum assured that will be paid will be 125% of your initial investment. If you bought a regular payment plan, your benefit payments, death benefit payments will even be a lot more than your total investments into the fund or into the policy. So what I've done is that I'm illustrating before you 30 years of peso cost averaging. Let's say you are investing 10,000 units. It can be 50,000, 100,000, 5,000, whatever in units. So instead of assuming this is the PSEI, let's assume this is NAVPU. All right, instead of 1,154, this is 1.154. So if you're investing 10,000 divided by 1.1, you buy 8,600 shares. Here, this is 0.653, 10,000 divided by 0.653, you bought 15,000 shares. See, you are buying a lot more shares when the index is down compared when the index is high in 2017, index at 8,550 or our NAVPU at 8.558, we were only buying 1,000 shares compared to 15,000 shares much earlier. See, without timing the market, you are buying a lot more shares when the markets are down and buying a lot less shares when the market is up. So see right now, 3 years ago in 2017, you can only buy 1,100 shares with your 10,000 pesos. Now you can buy a lot more because the market is down, and so our NAVPU is down. We can buy 1,700 shares. That is the next best thing to timing the market, buying a lot more shares when the market's down. So if you just did this for the last 30 years, your return would have been 5.5%. Or the banks will have to pay you 6.8% instead every single year for 30 years to get to that kind of return. So see here, your money would have been multiplied 2.5 times. Investments was 310,000. Your money right now is 773. So the money you place in 2010, 2019, 2018, you know, here, all these funds, even just placed in the last 5 years, 10 years, everything was doubled already. That's how peso cost averaging works over a long period of time. Over 20 years is the same. Also, by the way, before I forget, some points I've highlighted in yellow the years 2000 to 2003 because there will be times when markets will be down. And again, during these periods of time, our clients or ourselves as well, who are not used to long-term investing, might feel sad, might feel dejected, might feel despondent. We might just want to share, frustrated. But so in 2000, you would have told your client, come on, continue investments. These are for the long term. They invested another 10,000. Now the fund is 120,000. The market even dropped, and the value is only 88,000. and you still told them continue investing, it's now 130. The fund even was lower at 87%. At this time, 13 years into investing, your client or you are losing 40% of your funds. Who would not get frustrated? And a number of people would have said enough is enough. But if you're down here at down 40%, it will take you about 20, 30 years to get back if you just move your funds into bonds, especially at the current levels where bond interest rates are very low. But those who stayed the course, another year here, those who stayed the course already recovered their losses and made a lot more money. In fact, by 2017, this is almost ×4 already. All the funds would have quadrupled by then. So people who stayed the course in investing also make or recover their losses and make a lot more money. That's why the richest Filipinos are the businessmen, because they are making their money grow through their investments in businesses. Not all of us are businessmen, but we can benefit from the investment of this businessman by riding on the performance of the companies, especially by buying these stocks. 20 years is no different. There will be years in yellow in 2001 and 2002 where we will have losses, but again, people who stayed would have recovered their investments. And here, the returns in the last 20 years will be 6.6. You have to make 8.2% for a fixed income instrument to recover, to approximate this, because you have to pay a final tax of 20% there. Again, losses are experienced, but those who stayed eventually recovered the loss and made a lot more money. So if you started near the bottom, your returns are even higher, okay? Because here we started at a very low level, okay? So we expect that when you're buying, when shares are very low, your returns over the long term will be very high compared to when buying at very high levels. What about 10 years? If we illustrate it in 10 years, people who started investing with us 10 years ago on a single pay or regular pay products are losing money right now. But should they get out? My sense is no. If they understood markets, they will stay the course. It may be 1 year, maybe 2 years, but we know for a fact that because our economy is a much stronger position, number 7 in terms of resiliency among all emerging markets, very high rating that I showed earlier, we are well poised to recover these losses. Also because our valuations are not expensive. Again, those who stay the course will likely recover the losses and make more money. Clients right now who are fearful or panicking, assure them that over the long term, because of our strong economy, our resilient economy, we will weather these challenges in the next couple of years. So as I close my talk, currently we are facing unprecedented global economic challenges. We are in uncharted waters. Economy will be contracting closer to the experience after the war, and on peacetime, it's way back all the way to the early 1930s, late 1920s. So we can expect continued volatility in the marketplace. We should not be afraid with market volatility. These are opportune times to buy when markets come down. When I talk about volatility, it can also mean very rapid increases upwards. Market volatility does not mean just coming down. Because if we saw a swift down market in February and early March, we can also see a swift move going up if we are able to address the pandemic issues. Investment is not all about returns. So even if my risk profile is aggressive, I maintain some of my funds in bonds. Investment is not all about returns. You also have to balance safety and liquidity concerns. As I mentioned, currently, because of the uncertainty, we will have to maintain 6 months of liquidity. Safety, sometimes I switch to bonds, and depending on how I see the valuation of stocks, technically and fundamentally. Some people are trying to time the market. Some people are investing on their own, buying stocks individually, buying bonds individually. Studies have shown what's more important really in investing over the long term, over 20 years, over 30 years, is not that we time the market. Do we enter now? Do we wait for 1 month from now? Do we wait for 2 months from now? No, over time, what's very important is asset class. Meaning, where is your fund? Where are your funds placed? Are these in stocks? Are these in bonds? Are these in REITs, real estate investment trusts? Are these in money market funds? Are these invested globally outside the country? it's very important over time that you that will be the determinant of success in investing. So it's not all about just focusing on choosing your own stocks, choosing your own bonds, timing the market, but understanding when to switch partially or in totality from one asset class to the other. We will not make all the right calls all the time, but your fund managers will have a better chance compared to the average person in terms of movements in between asset classes. So we have 3 sets of balance funds that can help you navigate depending on your risk profile. On that note, yes, your best opportunities often hide in the shadows of your biggest threats. We are faced with biggest threats right now. Economies are on a standstill. We will be going back to work gradually by May 15. So some people see this as threats, but these are also opportune times. This presents opportunities from the investment side. On BUL, those who are in fixed income can also switch to some equity portion or some balance funds, depending on the risk profiles. And what this period has highlighted is the need for life and health insurance coverages, because this pandemic does not select between rich and poor, male or female, or young and old. All of us in the best of health can suddenly be afflicted by COVID-19, and it could be all over in a week or two. So even health insurance coverage becomes more important. We have riders to cover for health confinements. And so, some people are saying, no, I can afford that. But I have a neighbor who came from abroad and developed COVID, and she stayed around 10 days in a hospital, a private hospital, and she was not even confined in an ICU. Her bill exceeded over $1 million in 10 days. So because, she's a bit old, she's a senior citizen. So when you get confined, they will do a lot of testing. And because she also has multiple exposures to various illnesses, so she will have, I think she has 4 or 5 doctors addressing concerns for her heart, for her sugar levels, etc., etc. So health and life insurance coverages are the main winners also in this pandemic. It shows us the opportunities in that side. Investments as well, as we introduce PAM TC to the marketplace, there will be investment opportunities as the markets have become low. Again, investment is about buying low, selling high. The bond prices are a bit high at this point in time. We have to understand that. Stock market prices are a bit low at this time. So understanding those opportunities, we will be able to adjust our portfolios accordingly, according to our risk profiles and that of our clients. So on that note, I'd like to thank you all for staying with me for the last hour or so, and we will now open the floor for your questions. Maraming salamat po. Thank you.